Probably draw an analogy of, what's the situation like from 2008 to 2013 and what is the Nifty doing right now. Joining me right now, I've got Mohit Modi, Director Equity Research at CRISIL Research. Mohit, you all have put out a report. You put out a report, with the Nifty and what's been happening, what happened in 2008 and what's been happening in 2013. What exactly is the motive of this report? What are you trying to bring out?
See, we just compared the composition of the Nifty, and one of the bigger dichotomy was that while there is a lot of stress on the macroeconomic front, and also in the broader markets where we have seen almost like 550 stocks falling from 2008 levels by more than a half, the Nifty is still holding almost up to at the same level of January 2008. So what's giving resilience to the Nifty? The answer lies in changing composition of the Nifty towards consumption link, export link and private financials from an investment link Nifty composition in early 2008. The composition of the consumption linked export and private financials has increased from almost 29% in January 2008 to 65% now. Whereas the investment linked sectors composition, which is essentially materials, industrials, capital goods oriented sectors, this composition has gone down from around 66% to 31%. So there is clearly a lot of polarization towards the consumption linked story right now. If you look at Nifty valuations, the polarization is equally evident in the composition of the top 10 stocks. Today, top 10 stocks contribute almost 59% of Nifty, which is almost at a 5 to 6 years high. If you expect a broad-based Nifty movement, we would naturally expect that the composition of or the proportion of top 10 stocks to Nifty should ideally come down, and Nifty should behave in a broad-based manner. But today there is a lot of polarization towards a few performing sectors and a few performing scripts on the index.
But this equation in 2008, 2013 is quite different. I mean, right now, even with regards to the composition and the stocks which are there amongst the top 10 weighted stocks, they were different from what they were in 2008. So how do you draw an analogy to that?
Certainly, there is a lot of change that has happened in the index composition. Unfortunately, the very reasons which we believe are responsible for the consumption story or the consumption stocks to move upwards are equally responsible for the investment linked stocks to not do as well in the economy. We believe that consumption linked story has gotten a boost on the rural side from the rural employment guarantee scheme. On the urban side, with the middle classes increasing comfort with leveraging itself. Whereas on the investment link side, the very reason of Narega has actually hampered the productivity of investment link sectors. There are also policy related issues which have hammered down the earnings of investment link sectors. Valuation of the investment link sector, if you look at the price to book multiple, has come down from almost 7.3x in January 2008 to 1.7x now. So there is if we expect the indices to move up in a comprehensive way, we would expect the economy to fire on all its engines, and for that it is very important that the investment linked sectors get an impetus, whether it is from the policy side, also from the productivity side.
But at this point, the juncture that we are in, that looks a little bleak, because the measures that have been taken in all round, I mean, if you encompass all of them, it doesn't look like investment will rise anytime soon in a big hurry. So in that case, how would you stack up?
See, certainly you are right. Investment, the earnings of the companies in the investment linked sectors have been falling, and if you look at some of the larger, for example, the capital goods has shown a 21% decline in YOY at an aggregate level in this quarter on the revenue front. So certainly the earnings are under severe pressure. At the same time, going forward, if you look at Nifty, there are multiple scenarios that can emerge. One is that the valuations of the export and consumption linked sector, which are at quite a stress, they are quite at a stretch. I would not say they are as high as they were in January 2008, but they are almost at that level. If the earnings momentum there drops, then we would be seeing a sharp correction in the indices. At the same time, if we see policy impetus towards the investment-linked sectors, which would ease out some of the issues like the fuel linkages, the mining issue has somewhat gotten resolved, but there is still a long way to go there. If we see some movement over there, then we can expect somewhat of an earning improvement on the investment side.
So what you're saying right now is the saving grace for the index is that consumption has more weightage right now rather than investment-linked sectors.
Certainly. Consumption, private sector banks and export-related sectors, which is primarily large IT and large pharma companies.
Okay. Anything else that you want to bring to notice that one should watch out for in the future in terms of determining trends?
I think the most important factor would be earnings. Earnings are going to define the way forward for the broader market as well as for the indices. As I said earlier, any correction in earnings on the sectors which are performing could be very, very negative. At the same time, any improvement in earnings on the sectors which are currently beaten down could help in providing much more resilience and actually an uptick to the indices overall.
Got that. Mohit, thanks very much for joining us. Really appreciate those comments from you on that report there. We're going to take a very short break, but it looks like the market mood is worsening. The damage is getting deeper, and the mayhem continues in the broader market as well. We're down almost 2% on the benchmark indices for the Nifty as well as the Sensex. More than 2% actually. It's a cliff drop actually.